The market is always changing, and most don't keep up. You're going to see in this video how you need to adapt to it. This begins with traders analyzing the direction the market has been going. For example, we see how the Nasdaq on this 1-hour time frame, it has constantly gone down, with increased bearish pressure, but then suddenly the market starts aggressively going up. Now, after any change in structure, you want to closely analyze the price action with patience. So we take it from the basics. The price action says what it is by its name. It's the action of the price. So we analyze in more detail how the market has been moving since the beginning. For example, we started from a high, from where the market pushed down into a low. So we have the high and low fixed and visible on the chart. Well then, from the low, the market went up and formed another high, but lower than the last one, being a lower high, which was then followed with a pull to the downside that formed a higher low. So we have found the very first problem. We have a lower high, which is a swing point of a downtrend, and we have a higher low, which is a swing point of an uptrend. When this happens, it becomes extremely hard to know if you should buy a demand from the higher low, or if you should sell the supply from the lower high. Since they're 50-50 chances, the best thing to do is just to avoid entering with a setup and just wait for the market to either break above the high so you have one more confirmation for an uptrend, or wait for a break below the low so you have another confirmation of a downtrend, which is exactly what happened right here. It basically continued the downtrend by forming a lower high that was then followed with a lower low. Then after a lower low, you would wait for a lower high. But what happened is that the market gained huge bullish pressure that eventually pushed higher, and it managed to break above the previous lower high. Now, when the market is in a downtrend and it breaks the last high and it forms the first higher high, that higher high is a huge indication that we might have reversed into an uptrend. That's what we call as a change of character, or as a market structure shift from a downtrend into an uptrend. Now we need to know the psychology of traders and how others might think, because in downtrends it might make more sense to sell down from supply zones that are found on lower highs, because you don't expect the next high to be higher than the last one. So it logically makes sense to have the stop loss above the last high and take profit below the last low, because on downtrends you wait for a lower low to be forming. And this worked out well one time here. But as you keep doing it, the market eventually reverses and stops you out. As we see the next time we've done that, here, it ends up on a losing setup. The loss is not what hurts the most, because if you're smart, you notice the trend reversal. And we redress a losing setup into other opportunities. For example, the loss was caused because the market broke above the last lower high. When the lower high breaks to the upside, that's when the trend reverses into an uptrend, and from this high, the market aggressively pushed to the downside as fast as it also went up. So the question is, would this low end as a higher low, or will it end as a lower low? Usually based on the market structure, after a higher high has been set, the common swing level of the low is a higher low. But the problem here is that the last low was a lower low, so we don't have a confirmation. It would have been easier if we had multiple higher lows in a row. We would know in that situation that we just need to wait for the price to pull back near the past low, where we can look for a demand or support and place a buy position. But here on the market, it's harder because we're basically predicting the bottom of this drop, but we don't know if this drop continues down and breaks below the last low, or if it ends here and the market goes into bullish pressure. One important clue is the higher high because it invalidates supply zones or resistance levels, so it makes selling from the highs as not being worth it, because if the market continues its formation of higher highs, then you get stopped out with another loss. So if selling might not be worth it, then what about buying? Well, where would a buy position make sense? Buy setups are usually placed near the previous low because they leave a demand, and we have a demand from the last low, with the price sitting on that demand on the last candles. And after the demand has hit, the exact next candle has closed bullish, showing a potential sign of a bounce to the upside. The market might still bounce to the upside and then push back down into breaking the last low, so there is uncertainty. A simple solution to this problem is to lower down in time frames the moment the market hits the demand. For example, this is on the 15 minutes time frame, and we start analyzing the swing formations of this price action. Pretty much constant lower highs with lower lows that held to the point we hit the demand. Now, if we plan a buy setup from this demand, the exit for the take profit would be placed above one of the previous highs, since uptrends hold higher high formations. So now it won't matter if the market goes to the upside and then reverses back down, since we would be out of the position in one of these previous highs. The only way we lose this is, of course, if the market just breaks down this demand and completely ignores it. That's unlikely to happen because most of the times, even if demand or support levels don't respect and break down, in the short term, we'll often see a bounce to the upside, so it won't matter that much if it doesn't hold. So at first, we look for the first high as the target. Of course, the stop loss below the demand. And in that case, the risk-reward ratio is decent, but would at least go for a 1 to 2, so that would mean slightly above the first target. And if we look at the price action and analyze the directional bias, pretty much after breaking the last high of this time frame, the market went into an uptrend, but inside this 15 minutes chart, that's seen because of the swing levels of higher highs and higher lows being formations of an uptrend. Then we're started to see bearish pressure come back into the market. This recent bearish push managed to break below the last low. If we look closely, this is the first lower low after some time. The first lower low while the market was in an uptrend is the first major signal that we might have reversed into a downtrend. Since we have the lower low, the swing level of the high on a downtrend is a lower high, so we're basically expecting for the market to not be able to break above the last high on an eventual pullback to the upside. But this pullback should end below the last high in order to continue the downtrend that it just created. And this exact point of reversal is usually done from a supply or resistance which is taken from the recent high. That would be around this level. And we position the sell setup, stop loss above the supply, and take profit below the low. It starts pulling back up, hits the supply, opening the sell setup, rejects down right away from hitting the supply, and eventually drops back down on the take profit. There is a good reason why I mentioned to target the first low, or the second low at most. The first reason is to keep a balanced risk to reward ratio, meaning not too high, like for example a 1 to 5, but also not too small. In most cases, we don't want to target more than 1 to 3, because the risk increases by a lot, especially on this market. And as a recap, when we start to analyze the swing levels of a market, for example right here we begin from a high, then from that high it drops down into forming the low. From this low, it goes into a lower high, and from this lower high, it pushes down into breaking the last low, so essentially having a lower low. Now that we know we have a lower high coupled with a lower low, we know the trend of the market, obviously a downtrend. From downtrends, the most often done strategy is to identify a supply or resistance on the lower high, because it's from this supply where the next lower high will probably end. So if we expect the next high to not be able to break above the previous lower high, then it logically makes sense to have the stop loss placed above that high, and the take profit below the last low since we already have multiple lower lows. So what would be the chances that the exact moment where we enter the market it just stops forming these lower lows? In some situations it happens, but it's not likely. The probabilities are still higher for another lower low to be forming, and as this keeps repeating on, eventually the market has to break above the previous lower high. This showing the very first major sign that this market might have reversed from a downtrend into an uptrend. And on uptrends now, instead of sells, buy positions are usually favored. These buy positions are placed on demand or support levels that are taken from the last low. And you will notice how many times the market will pull into this demand, but the real question is that you don't know if this will end as a higher low and place a buy setup from this demand into taking the market above the last high into a higher high. The problem is that we have a lower low. That's a swing point of a downtrend, and that's coupled with a higher high, which is a swing point of an uptrend. So the market could just as well just continue what it has already done many times and form another low. And if that is to happen and we still have the same placements for the buy position, we obviously lose the setup. But what we can do instead is to wait the moment the price approaches the demand, moment where we switch into a lower time frame, and on that lower time frame, we have the same price just structured across more candles. This way, we can see the price action in more detail. Specifically, a push to the downside from the higher time frame will be seen as a market that's constantly forming lower highs and lower lows on the lower time frame. And the moment we hit the demand on the low time frame, we can still plan the buy setup from the same demand with a similar stop loss level, being below the demand. But what changes are the levels we are targeting for the take profit. We look to target the first level, or the second one, in such a way to get a minimum of 1 to 2 risk-reward ratio. And even if this demand would fail and break down later, we would be out of the position with hopefully a winning setup. All the concepts that were used on this video are described in depth from zero on the link in the description. where the goal is to hopefully save you time, and make sure to check out the last videos on this channel. We share a lot of value here as well.